Welcome to XRP Pro Ledger, and what just happened in the American banking system this week is the kind of development that most people in the crypto space are going to look back on as the moment everything changed, and most of them are going to miss it entirely because they are too busy watching price charts for green candles instead of watching the institutional rails being built beneath the market in real time. A US chartered FDIC insured bank just did something the legacy financial system has spent a decade trying to prevent. SoFi Bank, a nationally chartered OCC supervised institution, has officially integrated XRP directly into its banking ecosystem, placing it alongside Bitcoin and Ethereum under a federal banking charter. This is not another exchange listing. This is not a crypto startup adding a new token to its app. This is a Silicon Valley institution with federal banking supervision, deposit insurance, and OCC oversight, making XRP available to its retail customers inside the same environment where they hold their checking and savings accounts. The gate that the legacy system spent years trying to keep locked just swung open, and the people who understand what that means are not the ones panicking over daily price movements. Let us be very precise about what the SoFi integration actually means at the regulatory and institutional level, because the precision matters enormously here. And most of the commentary around this story is treating it as a convenience update when it is actually a structural inflection point. The Office of the Comptroller of the Currency is the federal agency that supervises and regulates all national banks in the United States. When an OCC-supervised institution integrates XRP into its customer-facing banking products, it means that the institution's legal team has completed a full regulatory review of XRP's status, concluded that offering it to retail customers is consistent with their federal banking charter obligations, and obtained whatever internal and external approvals were required to proceed. Banks do not add digital assets to their product stack on a whim. The compliance process for an OCC-supervised bank to offer a digital asset is thorough, rigorous, and documented. SoFi's legal team running that process and concluding that XRP can sit alongside Bitcoin and Ethereum in a federally chartered banking environment is the most powerful implicit regulatory validation that XRP has received from the private sector since the SEC lawsuit was resolved. One bank is a curiosity, but the history of banking tells you exactly what happens next. Banking is a game of follow the leader, and that dynamic is more predictable and more powerful in financial services than in almost any other industry. When one OCC-supervised national bank proves that it can safely custody, trade, and offer XRP to retail customers under a federal charter without regulatory pushback, it removes the single biggest barrier that every other bank's compliance team has been using to keep digital assets off their product list: uncertainty about whether a federal regulator will object. SoFi has now run that experiment in production, and the answer from the OCC is silence, which in regulatory language is the loudest form of approval available. Every other national bank in America watching SoFi's XRP integration right now is updating its own internal compliance analysis. The bank that moves second does not need to be brave, it just needs to follow the leader that already took the regulatory risk. And the bank that moves third needs even less courage than the second. This is how banking innovation diffuses through the system, and SoFi just fired the starting gun. The contrast between what is actually happening in the institutional and regulatory world around XRP and the narrative being pushed by the loudest skeptics in the macro finance space is something that deserves a direct and honest engagement, because ignoring the contradiction would be doing you a disservice. There are prominent voices in the financial commentary space, people who have significant platforms and significant audiences, who are currently claiming that Ripple will never deliver on its promises, that XRP has no institutional future, and that the smart money is moving to neobank platforms and other digital asset ecosystems instead. These are the same voices who are quietly pivoting their own strategy toward the exact categories of institutional infrastructure that Ripple is building. When someone publicly dismisses an asset while privately positioning toward the infrastructure it is powering, you are not looking at analysis. You are looking at someone talking their book. The data does not support the dismissal. The OCC conditional approval for Ripple's National Trust Bank charter, placing it in the same regulatory category as Fidelity and Circle, is not an opinion. It is a federal filing, and federal filings do not lie. Michael Arrington's recent description of Ripple as the defender of the entire crypto ecosystem is the kind of statement that deserves to be unpacked carefully rather than simply quoted, because Arrington is not a retail crypto enthusiast making optimistic social media posts. He is the founder of TechCrunch and one of the most respected technology investors in Silicon Valley. And when someone with that track record and that credibility uses that specific language about a company, the serious analysts in the room pay attention. What Arrington understands and what the skeptics who dismiss XRP are systematically missing is that Ripple is no longer just a payments company. The acquisition of Hidden Road, now rebranded as Ripple Prime, transformed Ripple into the first crypto firm in history to own a global multi-asset prime broker. Ripple Prime handles institutional clearing, custody, and treasury management under one roof. The combination of G-Treasury, Standard Custody, and Ripple Prime gives Ripple a full-stack financial operating system that competes not with other crypto projects, but with the entire institutional financial infrastructure that currently serves the world's largest pools of capital. XRP is not just an asset in this system, it is the bridge currency that makes the entire multi-trillion-dollar machine run without friction. The Federal Reserve's FedNow system expanding from 35 banks at launch to over 700 financial institutions by April 2026 is the macro infrastructure story that contextualizes everything SoFi just did and everything Ripple is building. FedNow is the Fed's real-time gross settlement system for domestic payments, the infrastructure backbone through which instant dollar payments flow between participating financial institutions. Its expansion to 1,700 institutions in a short period is not just a payments modernization story, it is the infrastructure build-out for a controlled digital transition of the US financial system toward instant settlement rails that operate in the same technical paradigm as blockchain-based settlement. The institutions connecting to FedNow are the same institutions that are evaluating XRP for cross-border settlement, the same institutions that are watching SoFi's XRP integration, and the same institutions whose risk managers are updating their digital asset compliance frameworks every time a new regulatory or banking milestone confirms XRP's institutional legitimacy. The FedNow expansion and the SoFi integration are not separate stories, they are parallel tracks of the same transition. The spot XRP ETF data provides the quantitative confirmation of institutional demand that makes the qualitative narrative of SoFi's integration and Arrington's endorsement something more than just positive commentary. ETF net inflows in the range of millions per day, with total assets under management approaching the billion-dollar threshold, represent systematic, recurring, compliance-approved institutional capital deployment into XRP through regulated financial products. These are not retail investors buying XRP because the chart looks good. These are registered investment advisors, institutional allocators, and brokerage platform clients making deliberate, documented decisions to add XRP exposure to portfolios that are managed under fiduciary standards. The quiet accumulation happening through the ETF channel is the institutional money moving first, the same pattern that preceded the most significant price discovery events in Bitcoin and Ethereum's institutional adoption histories. The retail market is still watching green candles. The institutional market is building positions through every available channel simultaneously, and the ETF data is the most transparent and measurable evidence of that building. The Uphold flexible staking evolution is a development that deserves attention specifically because it represents the retail accessibility layer of the institutional infrastructure story coming into focus. Flexible staking that allows holders to earn yield while maintaining instant liquidity is not just a product feature, it is the democratization of a capital efficiency strategy that institutional investors have been executing through prime brokerage for decades. When Uphold's leadership describes this as a way to position idle capital to capture a piece of the global value migration happening on-chain, they are describing the retail version of exactly what the institutional whales are doing with their $500 million accumulation positions. The $1.70 quadrillion global value pool that is preparing to move on-chain over the coming decade is not a number that requires XRP to capture all of it to create extraordinary value for current holders. Even the smallest fraction of that migration flowing through XRP's settlement infrastructure produces outcomes that the current price level does not reflect, and the retail products being built right now by platforms like Uphold are the access points through which ordinary investors participate in that migration alongside institutional capital. The Japan dimension of the XRP institutional story is the one that most Western-focused analysts systematically underweight, and understanding it requires appreciating the specific strategic logic that has made SBI Holdings the most committed institutional advocate for XRP infrastructure in the world. SBI Holdings did not spend a decade building the Ripple network in Asia because they were speculating on price appreciation. They built it because they identified a specific and massive structural need, the ability to settle cross-border value instantly without correspondent banking intermediaries, and they concluded that XRP and the XRP ledger was the most technically and commercially viable infrastructure for meeting that need at institutional scale. As of April 2026, roughly 80% of Japanese institutional investors are planning digital asset allocations within 3 years. Japan's urgency about digital settlement infrastructure directly tied to its exposure to global commodity supply chain disruptions. When the traditional rails of global trade are threatened by geopolitical conflict and sanctions, a system that can settle value instantly without a correspondent bank in the middle is not a competitive advantage, it is a survival mechanism. The complete picture that emerges when you assemble every development we have covered today: SoFi's OCC Supervised National Bank Integration, Ripple's Conditional National Trust Bank Charter, Ripple Prime as the first crypto firm with a global multi-asset prime broker, Michael Arrington's Defender of the Ecosystem thesis, FedNow expanding to 1,700 institutions, spot ETF flows building toward the billion-dollar AUM threshold, and Japan's institutional urgency about instant cross-border settlement infrastructure is a picture of an asset that is being woven into the fabric of global financial infrastructure at multiple levels simultaneously. The skeptics looking at the price chart and seeing an asset stuck between support and resistance are looking at the wrong data. The institutional allocators building positions through every available channel, ETFs, on-chain accumulation, national bank custody, staking platforms, are looking at the infrastructure data and concluding that the current price level does not reflect the institutional reality being built around it. The bank stamp of approval that nobody expected just arrived, the gate is open, and the elite are simply waiting for enough retail investors to walk away before they close it behind them. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.